Hey, this is Brett Bonecutter with Monarch Capital on Friday, May 16th, 2014 with a quick mortgage rate update. If you look at our bond chart and you've watched this before, you know that every vertical line represents a day. And as the lines go up, rates go down and vice versa. It's a bit counterintuitive, but that's because bond price and yield move inversely. So what you can see is that while yesterday was the best day that we've been at, and really for 3 months and more, today isn't quite as good, but absolutely still one of the best days in the past 3 months. And if you go back and look, you can see we're actually at some of the best levels since last October. So, you know, we're on quite a good rally here. Now, we're still not at the absolute lows that we were at historically, but we've recovered about half the ground. You can see that here. What's causing that is, you know, continued concerns over the Ukraine and Russian aggressiveness there, but also just weak economy in the U.S. So you can see what that means for rates right now. 30-year fixed rates are trending in the low to mid fours, depending on your scenario. 15-year fixed in the low threes, and again, you've got adjustables well in the threes. So it's looking pretty good, and if you look at it compared to our 52-week range, we're pretty much smack dab in the middle. Now, I know that a lot of consumers really like the 30-year fixed, and they certainly like to see the 30-year fixed in the threes. And I think one of the questions is, you know, how long or what's it going to take for us to get there? Well, even though there's not a direct relationship between the 10-year yield and the 30-year fixed, the 10-year yield is a pretty good barometer for what 30-year fixed rates do, because 30-year fixed rates generally have a 10-year duration. In other words, people don't tend to stick in 30-year fixed loans for more than 10 years. And you can see right now that that's sitting at about 252. Without getting into all of it, the bottom line is if we see this yield fall into the 230 and 220 range, I think we would get back to the place where we see those 30-year fixed rates back in the threes. So we need about a 200 basis point rally from where we are right here. We got to get back into this range to get back in the threes. Now, do I think that will happen? You know, I'm not sure. This has been a really strong rally. You can see that started in early April. You know, I'm somewhat bullish about rates because I don't think our economy is that strong. However, with run-ups this strong, sometimes I do expect to see the wave come back the other way. The bottom line is, you know, when you're looking at whether to refinance or purchase, it's all about risk management. It's all about understanding the what-ifs and what your tolerances are. It's a great time to act. You know, if you want to take, you know, don't want to take your chances and feel like you're a gambler in Vegas and just save some money now. However, if you've been hanging out in the mid fours and you're waiting for the low threes, it could happen. Just continue to watch it. We'll watch it for you. And again, if you see that 10-year tripping into this 230 type territory, you know that, you know, rates are probably going to be in that 3% range on the 30-year fixed. I hope this helps. Have a great weekend, and we'll talk to you soon.